You have found Authentic Business Adventures, the business program that brings you the struggle stories and triumphant successes of business owners across the land. Coming to you, well, we're just wherever we are, right? Sarry, I don't even know where you are today. Where are you at?
Hey, James, I'm actually in Chicago, Illinois.
Awesome. Okay, well, you're not that far. I'm just by Madison here. So we're both in the somewhat frozen tundra, so it's all good.
Right.
Past episodes of the Authentic Business Adventures podcast, just as a reminder, can be found at drawincustomers.com/podcast. My name is James Kademan, entrepreneur, author, speaker, and helpful coach to small business owners across the country. And today we are welcoming / preparing to learn from Sarry Ibrahim, a financial professional, a member of the Bank on Yourself organization, and the owner of Financial Asset Protection. So Sarry, how are you doing today?
Hey, James. Good. How about you?
I'm doing very well. I'm excited. And I guess I'd be lying if I said I wasn't a little bit curious. So let's just dig right into it. What is Financial Asset Protection, the business?
Yeah, definitely. So we are a financial services firm located in Chicago, Illinois. Pretty much what we do is we help clients build safe, predictable wealth. A lot of our clients are business owners and real estate investors. We don't typically work with like mutual funds or index funds or the stock market. We typically work with a little known strategy that is secure and has guaranteed and predictable growth.
All right.
So pretty much it kind of started, this company's been around for about 5 years. But during that time, actually before, the way I got into this whole organization and everything was through Medicare. I was a Medicare consultant and I was working with a lot of retirees, people who were like 64, 65 years old, and pretty much merging onto their own plans. And I was their consultant at that time. And one of my clients asked me about life insurance. He's like, hey, you're a broker, right? Could you help me with life insurance? And I told him I had my license, but I wasn't really sure exactly of how, the intricate parts of life insurance. And he's like, he wanted life insurance that also had cash value in it, like a savings account that grew over time. And I wasn't really sure of what he was referring to. So I told him I would do research for him. I get back to him. And I did. And I went to Amazon and I searched for books about life insurance. And I came across this book called The Bank on Yourself Revolution by Pamela Yellen. And the book pretty much talks about this strategy called the Bank on Yourself strategy, or the Bank on Yourself concept. It's also similar to the infinite banking concept. Pretty much it's using an insurance product to build up wealth over time and to not have to worry about the stock market, to not have to rely on banks. And also while you're doing this, you can become your own source of financing. So that's what we do. And that's what we help clients do.
Interesting. So if you're dealing with Medicare at the time you were, how old is this guy?
He was like 70. Like around 70 years old.
And he's coming to you looking for a whole life policy.
Yeah, so that's a good question, actually, good observation. So it's hard to do that when you're around 7 years old, but it's still possible. You can still, underwriting is a little bit less strict when you're working with single premium cases. That's where it's like a lump sum case into a life insurance policy. Like somebody's rolling over a 401k or IRA. The underwriting behind that seems to be could be a little bit less strict. But yeah, typically life insurance, you want to get that when you're in your younger years to get better rates on it.
Sure, because I imagine a policy for a 70-year-old guy is $10,000 a month or something like that. Like a 70-year-old guy died isn't like, oh my gosh, get the front page of the newspaper ready. I don't know what the average lifespan is, but I imagine for a guy, it's in the neighborhood of 72, 74.
Yeah, typically in that situation, they would be doing like a single premium case, like rolling over like $400,000, and he would instantly have like $600,000 in life insurance. That's a typical case with somebody over the age of 70 or even over the age of like 65 doing one of these policies.
And then is he also receiving a monthly nut?
So no, it's actually at that point, he'd be paying up the whole policy. It's like buying a house in cash. He'd be pretty much buying it all up and then not have to pay anything on top of that, but he would have liquidity. He'd be able to borrow against that cash value at any time and then still have it grow even when he borrowed that money. So imagine you have a savings account that's earning you 5% interest on it, and then you wanted to access that money. If you access from it, you would interrupt the growth of it, right? But if you borrow against it, let's say you could borrow against it and then pay like 2% interest on that loan that you borrow against it, you can still get the growth in the policy while being able to use that money. That's kind of what this whole strategy is about. It's about growing the wealth. And then when you want to access it, you borrow against it from a different source. So that way you're not interrupting the growth of your money.
Oh, interesting. All right. Well, you brought up a couple of things, and I'm like, wait, what? First of all, what savings account that's paying 5%? Because I want to find that one.
Exactly. Yeah.
The
I don't
one
think
that I have is like 0.01%.
that's pretty typical. Yeah. I don't think there's any savings account that's paying 5% interest right now.
Yeah,
Yeah.
and then you're mentioning that you can essentially borrow against your investment
Mhm.
without losing. So let's just say, just for easy numbers, let's say I got a $500,000 investment.
Mhm.
I want to buy a boat, whatever. So I pull $100,000 out of that. I'm not reducing the interest earning power of my 500,000.
Correct. Exactly. You're borrowing against it.
All right. So tell me, I guess, just help me understand how that works.
Yeah, definitely. So pretty much what we're talking about here is using a whole life insurance policy, but we're not talking about, so pretty much whole life insurance has two aspects to it, two parts to it.
Okay.
One part is the life insurance part, and the second part is the cash value part. That's like a savings account in the policy.
Okay.
And then as you're building up the cash in the savings account part of the policy, you're earning interest and dividends on that money. It's growing over time, it's compounding. And then when you want to access it, you would ask the insurance company for a loan. It's like a personal loan between you and the insurance company. And then when they give you that loan that you borrow, you're not subtracting from the balance, you're borrowing against it. So they're pretty much self-collateralized. They're collateralizing the policy itself with the loan that they're giving you.
So the money itself is essentially coming from two different places.
Exactly, yes.
Collateral of the money that you have
Yep.
in this policy, and then the insurance company is essentially lending to you. Gotcha. That makes sense. That makes much more. You explain that so much faster than a lot of other guys. So I appreciate that.
Yeah, thank you.
The other thing I want to ask you about is this guy, the 70-year-old guy that's going to pull his 401k to throw it in this policy. I imagine there's some tax ramifications for doing that. Is that safe to say?
Yeah, typically with life insurance, when you're funding it, you're using after-tax dollars. So pretty much if you, in this example, let's say that somebody has $500,000 in a 401k and they want to move 500,000 into a life insurance policy, they can't just roll 500,000 from the 401k into the life insurance policy and completely dodge taxes. They would have to use after-tax dollars to fund the life insurance policy. So let's say, for example, 20% went to taxes. So 500,000, take off 100,000 in taxes. They would put in 400,000 that way. Or what they could do is take $500,000 from the 401k, put the entire amount in the life insurance policy, but then pay the tax liability, the tax bill from the insurance policy. So they would, when you take the money out, they essentially ask you, do you want taxes to be withheld or do you want to pay the taxes on your own?
All right.
So you could do it that way. You could use the policy to pretty much finance your tax liability the other way.
Interesting. Okay. Interesting.
Yeah. And then pretty much the growth of the policy as it's earning compound interest and growing, it's growing tax deferred. So you don't have to claim those on your taxes as it's growing. And then of course the death benefit is tax free too. So there are tax benefits or tax advantages using the strategy as well. And I really wanted to share this on your podcast because a lot of business owners could use a strategy, while they're still, in their 30s or 40s, they could still use a strategy and to be able to recoup a lot of their profits. For example, let's say you have a business and you're pretty much earn let's say just, rough numbers of $50,000 a month in revenue. And then you have your expenses after that. What you could do is you can have some of those dollars go into a whole life policy, build up the cash value, and then use the policy to pay your expenses. Some businesses have 30 or 60 days or 90 days to pay off their bills. They could use this policy in between, exchanging hands. So that way they could earn interest on their money and kind of have cash reserves in their business growing and compounding while they're running their business.
Interesting. And that's a life insurance policy that the business would then hold on the owner?
So you could do it either way. So we always do a financial analysis with clients to kind of figure these things out, but you could do it both ways. You could personally own a life insurance policy and then loan the money to your business and have your business pay yourself back. Kind of you're pretty much becoming your own lender, or you can have the business own the life insurance policy as an asset on its balance sheet. And it pretty much be like a cash reserve place for the business to store its cash and kind of have an internal line of credit.
Interesting. And what a typical account like this, how much are we talking from an interest point of view?
So the cash does grow two ways. It grows from interest and dividends. And then you can kind of see with both of those compounding with each other, you can kind of see between 5 and 6% growth every year. And one of my favorite things about this is that it's not like an either or approach. It's not either, I put money into this whole life policy or I invest in my business or I do real estate. It's a way where you can kind of do all these things at the same time. You could fund it, grow the cash value, borrow against it, and then use that money to invest in different places. there's no restrictions on what you could use the money for. You can kind of, you have your dollars working for you in numerous places.
Interesting. Is that a 1-to-1 ratio? Like if I throw $100,000 in there, can I then borrow $100,000 against the policy?
Typically, no, because there's going to be some fees involved with the product, and then also the insurance company can't give you like 100% financing. They need some collateral, so they usually give like a 10% cushion. So they'll give you like 90% of your current cash value.
Okay.
With a lot of single premium cases, that's where you just do like a lump sum transaction. With a lot of those cases, if somebody puts in 100,000, their cash value might be 95,000, and then they could borrow up to 90% of the 95,000. So they'd have to leave some room in there to account for the collateral.
All right. And you raise an interesting point here with the term cash value.
Mm-hmm.
Does that mean if I throw my $100,000 in there, and if I ever want to pull out, I can get 95 back?
Yes. Okay. In the first year. And then after that, it grows about 5 to 6% every year after that year. Even without any more dollars going into it, it's still going to grow. So typically the first year, you'll see about 95,000 in cash value. The next year, 5 to 6% growth on that. And then the death benefit, of course, the life insurance, that also grows every year too.
Gotcha. Interesting. Very interesting. So do you find most people give a lump sum, or do you find most people just try to do that monthly, or it feels like with a whole life policy, you're trying to play catch up for the first 10 or 15 years?
Typically, you're right. Typically with whole life insurance, a lot of the traditional old school life insurance policies, it takes about 15 years just to break even. We only use companies that have a proven track record of paying dividends and interest for over 160 years. We also structure it a little bit differently. Instead of doing 100% life insurance, we'll do like 50% life insurance and then 50% of this thing called the paid up additions rider. That the rider is something you add onto the policy that helps turbocharge the cash value. So we've worked on cases where like year 3, they could break even and then start getting gains after year 3.
Oh, interesting. Yeah. Can you explain that last part that you mentioned?
Yeah. So pretty much, let's say somebody puts in $10,000 a year. Year 1, they might have a slight dip in their cash value. So they pay $10,000 into the policy. They'll have like, $6,000 or $7,000 in cash value. Year 2, they put another 10,000 in. Now their cash value is at like, I don't know, 23,000, 24,000. And then the third year, now they've exceeded, their cash value might be, 32,000 or 33,000. So they're already kind of on the upper trend after year 3. And that's what we aim for. We aim for the break even point to be around year 3 and year 4. And then after that, to start seeing that compounding growth afterwards throughout the years. Now, to answer the other question you had about what do we do? Do we do single premium cases or do we do monthly? It all comes down to the financial analysis. This helps us determine how much cash the client has, cash flow, income, other sources of income, and we pretty much put it all together and then to come up with like a strategy that helps them, advance their financial situation. So some situations, if it's a real estate investor, they have like, 3 properties that are expecting to sell them and they're expected to sell each one for like $400,000 in cash. A single premium case might be good for that person because they have large amounts of cash, and it might be some delays between them finding their next property, so they can have that money sitting in the whole life policy in between finding the next property. Now, if it's somebody who's younger, they're like 25 or 30 years old, they're still starting up their lives, we could do a policy that's like $300 or $500 a month, and then that would grow and earn interest over time and still be still have liquidity in it. Also, it doesn't just end there with one policy. We always do a 6-month review with clients. We show them how we test out their cash value. We run that alongside their businesses. We see what's happening. Like, is this working? Are there any improvements? And then we might add new policies as we're going along. So it's very common to see a client have, a single premium case and monthly payment case, both situations.
Gotcha. So I guess the main advantage that I can see of this, since 5% is decent, but it's not stellar, the main advantage is that you can essentially use the money in 2 ways. One is it's growing at 5% or whatever, and then you can also borrow against it to use it as an investment somewhere else.
Exactly. Yeah, you could take that money out and put it somewhere that could potentially earn you, 10 or 12%. That way, and then if something happens to that investment, you have your original cash value to fall back on. It's almost like a hedge against that risk.
Sure. Interesting. And what the insurance company is charging you for essentially lending you that money, that's low, I guess, as far as that goes, or that's fairly inexpensive. Is that the idea? Typically,
it's 5% simple interest. Okay. So 5% simple interest, when you compare that, for example, on a 4-year run, it comes out to about 2% APR. So a lot of times what happens is people, for example, will borrow from their policy at 5% simple interest, earn 5 to 6% compound interest on their money. Eventually, the growth of their money outpaces what the cost of capital was. So it ends up being almost like a negative interest rate. Like imagine buying, a property, and then 5 years later, you have the property paid up through the insurance company that you used. You have the appreciation in the policy, and you have the appreciation in the property that you finance. So your cash grew two ways, and actually the growth of the cash over time outpaces what you paid in capital to use that money.
Interesting. So this, I can't help but ask this then.
Mm-hmm.
The insurance company is making money, and they're not doing this out of charity or kindness or anything. So how do they make their money if everyone is just throwing their money in their policy and then turning around to borrow it again?
Yeah, so the insurance company has some banking functions. They're pretty much investing their money in different places. Like for example, when you go to a bank and you deposit, $100 in a bank, mm-hmm. You're pretty much loaning a bank money. You're loaning them $100. Now the bank is in debt to you $100. They're taking that money and they're investing it in different places. They're earning interest on it, but yet they don't give you anything back on your money. The only thing the bank is giving you is a guarantee that you could pull that $100 out anytime you want. That's kind of the trade-off with using a bank. Mm-hmm. Insurance companies are the same way. You're giving them premium dollars. They're guaranteeing you a life insurance, or in other cases, other types of insurance. But on the back end, they're using those premium dollars and they're investing it in different places. The difference between what banks do with their money and insurance companies is about risk management. Banks can kind of invest more on riskier sides. They can, loan money out via credit cards, mortgages. They could do riskier investments and earn higher rates of return. Whereas insurance companies have to be very cautious with where they invest their money. They could only typically invest it in the bond market. About 60 to 80% of their portfolios in the bond market, and the other 20 to 40% are in loans to other financial institutions and to their customers. So when you go to an insurance company, you have your whole life policy with them, and then you borrow from the money from them, you're paying the interest back to the insurance company. That's one of their sources of income. That's kind of how they make money. And again, it comes down to the risk part of it. The insurance companies we work with, they've been around for over 160 years. They have a proven track record of paying dividends and interest, unlike a lot of banks who kind of come and go, especially after 2008. I remember I can't even remember the names of the banks before 2008 because they're kind of like, they've kind of like vanished by that time. Mm-hmm. During that time. Whereas insurance companies have a very long track record. They have very solid names because of what they're doing with their dollars. So we always tell clients, think about you're going into when you're passively investing somewhere, or passively saving your money somewhere, you're essentially going into business with that company or that person. And you want to go into business with somebody who's been around for a really long time and who has, a track record of paying out dividends and interest for a really long time. And insurance companies are typically really good at doing that.
Okay. So just, I guess for the people listening here, this is not something that's federally insured or something like that.
Yeah, correct. It's not FDIC insured. Correct. Okay.
So if the insurance company goes belly up, mm-hmm. you could have a bad day, just like a stock market investment or something like that, right?
Yeah. And there is something called a guaranteed association with insurance companies that guarantee the claims that the insurance company signed into. So for example, if an insurance company agreed to pay out all these claims and they went out of business, there mm-hmm. is a government entity on a state level that guarantees those claims. Yeah.
All right. Nice. I tell you, man, the whole insurance world is just something that I have never really poked around much on so many levels, right? I'll give you a just really quick example. I don't know how relevant it is, but we had, I had it onto my garage years ago, and the contractor that I had is like, hey man, you're going to have to do the roof, and it looks like your roof has hail damage. So just submit a claim with your insurance company, and they'll essentially end up paying for part of the roof, and then you'll be stuck paying for the new roof. Mm-hmm. I'm like, okay, I'm not a roofing guy. So I call up the insurance company. They send out a person, and that person says, nah, there's a little bit of damage, but not enough to justify a claim. So I go back to the contractor and I'm like, okay, the insurance company said, no, you're saying yes. I don't know what to do. And he's like, call him again. So I call him again. And they send somebody else out and they essentially say the same thing. And he's like, your insurance company's crap. They're no good. Later, we're talking 4 years and 10 months later. I go to change my homeowner's policy. My homeowner's policy, the quote comes back and I'm like, all right, rock and roll, here we go. And about 3 days later, I get a letter Now this is the broker, the insurance broker, just someone I know from networking, whatever. And she's like, "Hey James, funny story. You remember that quote that I gave you? Yeah, it's actually $500 more a year." And I'm like, "Well, that's kind of a big jump. What happened?" She's like, "Well, you got a claim on your roof here."
What?
And I'm like, no. We tried to get a claim on the roof, but they told us to go pound sand.
Yeah.
And she's like, "Well, it doesn't matter. If you make a claim, regardless of if the claim was paid, the insurance companies consider that a claim." I'm like, "Wait, what?" And that led me to this whole rabbit hole of finding out there's some company that keeps track of all this kind of stuff.
Mm-hmm.
And they keep track of this claim thing for 5 years. And I'm like, wait, we're just like, I think by the time all is said and done, it was less than a month away from the 5-year window. So I'm like, "You're going to charge me $500 extra for this 1 month?" And she's like, "Them's the rules." And I'm like, so I just walked away. I just kept what I had.
Yeah, that's actually unfortunate. But I worked with a lot of homeowners insurance companies before. I worked at Allstate, and we would typically calculate how much was paid out, during that time. If it's zero, then we go to the underwriters. We tell the underwriters take the claim off because it was a $0 payout. So
interesting.
I think the broker could have done that. It depends on the company, though. This is more of like Allstate, State Farm, Farmers Insurance.
Yeah, this was one of those
Okay.
that I was gonna go to, and she had her rule book that said that, and she is kind of funny. This is where like sarcastic James kicks in. She's like, "It's just $500. It's not the end of the world." And I'm like, "Well, you're $1 billion company. Probably not the end of the world for you either." So if it's not the end of the world for me, it's certainly not the end of the world for you. So I told her to pound sand. But it was interesting just going down that rabbit hole to see who's keeping track of all this stuff where there's not even no payment was made.
Yeah, it's kind of like a catch-22 kind of thing where it's like technically it is a claim made, but then $0 payout, meaning that if you look back at that record from the same company, it would show they paid zero. So then the insurance company could then remove that claim because nothing was paid out. And you're right. Insurance companies do hold this data. They hold this information so that way they can kind of protect each other.
Right.
And people don't go to like one company, take a whole claim. They go to another company, take another claim, and then just kind of keep doing that over and over.
Yeah, I get you got to keep people honest and stuff like that. But I'm like, I just did what my contractor said. I wasn't like I was up there with a hammer and a golf ball or something. Like I'm just like, okay, I felt like such a pawn because I'm like, I'm the one paying for all this.
Mm-hmm.
And I don't know, I got the insurance company saying I owe more on that side and the contractor guy saying that I owe more on that side. Like, wait a second. I feel like I was just less educated than I should have been. And I didn't even know where to get the education. I really had to press this woman that was trying to sell me insurance. I can't even think of the name of the company that keeps track of all this. But I'm like, that's your job? That's your business? This is keep track of claims nationally for all these insurance companies? What a crazy business. It's just one of those, like, you're not making the world a better place at all. Which is exactly. Kind of like, I try to do that with my businesses. Maybe I'm just kind of a rainbows and unicorns kind of guy. But like, you serve in the zombie apocalypse, no one's going to be like, quick, we need an underwriter.
Yeah, that's true. Exactly. It is kind of, there's some things I don't like about it, like it's definitely a very heavily, capitalized thing. You're holding all these dollars and then you're trying your hardest to retain these dollars before paying them out to people.
Yeah, I guess in the end, insurance is just a promise that you pay for that you hope the insurance company doesn't have to keep. Or you don't have to ask them to keep is essentially what it comes down to.
Yeah.
So, yeah. At any rate, let's talk about you and your business specifically. How did you get involved in the Medicare thing?
Yeah. So I kind of was word of mouth where I was actually working at Allstate before that. And then
really? Okay.
Kind of word went around between all my colleagues that like you could, make a big difference with Medicare. And I actually I was kind of confused when I first did it, but then when I started to actually do it and going out to people's homes and sitting with them and showing them this is how, and I would do an analysis with the clients too. Where are your doctors? What kind of prescription drugs are you taking? And we try to match that with the right plan to make sure that they were going to be taken care of. And then people started appreciating this a lot. They're like, hey, this is a big deal what you're doing. You're coming out here, you're doing all this work for us. And people would always say how much do I owe you? And I would say, oh, I don't charge any fees. I get paid directly from the insurance company. I'm like a broker. I get paid from the insurance company. I don't charge any fees. And they'd be shocked like that I'm not charging them a fee from all this. So I saw a lot of gratitude from doing this. And it was it became like, and I still do Medicare. I still do it. I still have my clients. I still prospect. So it was kind of unintended, but after I did it, I kind of stayed in it. And of course it led me into the bank on yourself concept. And so it kind of goes hand in hand. It has a lot to do with retirement planning and just planning for the future, and pretty much overall helping people. And I think that one thing that's really cool about entrepreneurship is that it's more of like problem solving, right? You're finding a problem and you're connecting the solution, and you get a fee for connecting people together, either directly or indirectly. Somehow, some way you would get paid for doing that.
Sure. Tell me, you raised an interesting point here. I guess I don't want to get too far off topic, but let's just talk about how you get paid. Because commission world, especially when it comes to financial products, there can be a shady area. So can you just talk about that a little bit?
Yeah, definitely. Yeah, thank you. And I like to be as transparent as possible with this with clients, because typically in the financial services world, there's kind of, for the most part, not every part, but for the most part, there's kind of two different avenues. One is fees or assets under management, where, for example, you go to a financial advisor, you park $100,000 a year with $100,000 with them. They get paid, 1 to 2% every year for the life of, as long as you're with that advisor. That's how a lot of financial advisors make money. They charge portfolio management fees. They charge, 1% up to 2%, something between there. And then there's the commission world. This is more on the insurance side. This is, you go to your financial advisor, who's also a licensed insurance agent. And then you would take, for example, $100,000, put it in an annuity or a life insurance product. And then that broker advisor would get paid commission from an insurance company that they used for that transaction. And then they would get paid commission. We are on the commission side. Now, this is also, you mentioned a good point too, is that it can kind of get a little bit shady, right? Because me talking to a client, they might think that the only reason why I'm recommending this specific company is because I'm essentially going to get commission from them. And that is true. The good thing though is I am an independent broker. We're an independent agency. That means that we're not captive to one company. We don't have to sell for, we work with typically 3 companies: Lafayette Insurance Company, Security Mutual, and Foresters Financial. We're not captive to each one. We're only doing this because we feel that these products could best fit the bank on yourself strategy, which could best fit the client. And if the client, for example, just somehow we found another company, a 4th company that could do all of these things and better, I'm in no situation, or I'm not held captive to any of these companies. So I could bounce and pivot and do the 4th company if there was a 4th company that is always better. So pretty much we've kind of positioned our agency to represent the clients first and then represent the insurance companies. Another good thing too about commission only is that we only get paid from the first year commission. So that means, for example, if somebody's putting in, $400,000 into a policy and their cash value year 1 is $375, the $25,000 difference, a part of that comes to us, not the entire amount, but a part of it comes to us. The other part goes to the underwriters, the actuaries, the medical company that does all the lab testings and all that. It gets kind of broken down into all those places, but we get paid a percentage of that. And then as the client now is earning dividends and interest and growing their policy, we're managing their policy with them. We're growing it, but we're not charging recurring 1 to 2% fees every single year. We get paid the first year. And then after that, we still manage it the same way how we started the policy, but it keeps growing. Now, this means that the client doesn't have to consider us as an expense when working with us. We don't charge hourly rates. We don't charge service fees. We only get paid from the first year. And then eventually too, the client ends up recouping the cost of insurance. So from $375, for example, an example of putting in $400,000, eventually you break even. And then plus you get more interest and dividends on top of that without subtracting out for fees. Unlike other investments, as your portfolio is growing, you have to pay out 1 to 2% every single year, whether it goes up or whether it goes down, you still have to pay that fee. So it's kind of a long answer. That's how we get paid.
Right. So just so I understand this, someone like you is getting a nut at the first sale, first year, but you don't get residuals every year as renewals go on?
The residuals are like, I don't even consider them. It's like a fraction of a percent. That just for having the client on your book of business, it's really, tiny. It's very tiny.
Okay.
And
like you get the check for 37 cents or something?
Something like that. Yeah. I always just say, it's initial commissions because the residuals on the back end are so tiny.
Okay. All right. Why do you think that is?
Because the insurance company is collecting a lot of so with life insurance, this is how it usually is. The insurance company is giving out the commissions mostly in the first year because most people don't die in the first year of life insurance, right? Probably 99.9. Probably 99.9% of insurance policies, I don't know what the numbers are, but it's for sure not in the first year, 99% of term life insurance policies don't even make it to a death claim,
Right.
If 100 people buy a term life insurance policy, 99 of them will outlive that policy.
That's one of the main reasons I bought it. Just because I figured this way I don't die. At least I know for the next 30 years I'm safe.
Yeah. So that's typically why. Now with other types of insurance, like auto insurance, home, business, those brokers and agents get paid every single year, like 10% or 12% every single year for as long as you're with that broker, because it's a smaller amount, but it's every single year. And there's also marketing purposes for that. So that way you can help retain that customer. With life insurance though, once a client typically enrolls, they're pretty much staying in a policy for 30 years with you. They can't really change that company. So that's why the insurance company gives you a large lump sum in the initial year, as opposed to 10% every year after that, at that point.
Gotcha. Okay. Very cool. Do you have employees?
Yeah, I have 2 assistants. They help me with marketing, and they help me with getting on the podcast and pretty much communicating with clients and podcast hosts and doing a little email marketing and things like that.
Gotcha. So are they subcontractors, or are they employees? Like you just hire them for project stuff, or?
No, they're hourly employees. I pay them hourly rate. And I also have a couple of contractors. I have like a content writer. I have like a digital marketing company that I pay out to, like a retainer, and they help with my website and digital marketing and things like that.
Sure.
And and hopefully my goal is to kind of grow the company to the point where I have agents within, my agency that are actually selling, because I'm doing all the selling right now and the prospecting.
Oh, wow. Okay.
But I would plan on kind of stepping back and having agents who can actually close the business, and I just support them that way.
Sure. Very cool. So one thing I always like to ask business owners that have employees is, can you tell me about your first hire? When did you decide to hire them, and what did you decide they were going to do? And just tell me a story about if that was easy or tough.
Yeah. So pretty much good question. So pretty much what I did was I made a list of all the things I needed to do. And then after that, I kind of figured out or thought of a way that I could kind of subtract my list, like shorten my list and focus my list on more of things that have a bigger impact on my business. Like, for example, being on podcasting. I can only do that myself for the business.
Sure.
And then also closing deals with clients. For now, I can only do that. Everything else, I can kind of outsource it out. And I started by a list. And then another thing too I did was I didn't just bring somebody on and then just take everything that I'm doing and put it on their plate, because it's too much and they don't see the same vision that I see. So I kind of have to translate that vision. I have to kind of show them what I'm seeing by like continuously training them, and then by giving them like small tasks first, because I want them to like conquer those tasks and then like eat it up and then come back for more. And then eventually, this is how I think companies have like really good employees that could pretty much duplicate the owners, is because they kind of just had like small bits, and then they got really good at it through practice and through coaching and mentoring. And then they have the ability now to almost like duplicate the owner without the owner even being there. And that's, of course, that's the best business to be in, is where you don't have to necessarily be in your job or in your company, and your business can keep moving. That's like, I think the ultimate goal of entrepreneurship.
So if it's not, it should be. Very true. Very true. Very true. I want to ask you a little bit about how COVID has affected your business. Because I imagine before you were able to get in front of people, say, hey, shake hands, kiss babies, whatever. And now you're like, hey, email or video or whatever.
Yeah, good. Yeah, good question. So I essentially got into this business because it's a very remote business. You can entirely do this over the phone and online. So even before COVID, I still had like appointments like over Zoom and over the phone. And a lot of my clients actually are not even in Chicago. They're all over the country, in different states.
Oh, very cool.
Yeah. So even before COVID, that's how the business was structured. But there are some things that COVID affected. Like, for example, when COVID first hit, a lot of insurance companies upped their like requirements, like medical requirements, because it is a pandemic and a virus. So insurance companies had their antennas up when it came to this. And then they kind of were denying a lot of cases or postponing a lot of cases for at least a year.
Really?
That affected our business slightly.
All right.
And then after that, once they got more, once they got more medical information, more medical data from third-party researchers and from doctors, they loosened up their underwriting because they probably became more familiar with the virus.
Okay.
And then also, as far as networking, my goal was to keep going to like networking events, but that's obviously changed. I don't think there's any networking events nowadays. And that's why I kind of replaced it with podcasting, to go out and meet people and talk to people, virtually.
All right. Nice. So did you guys ever have an office, or were you all just working remotely?
We were always working remotely, actually.
Okay.
So, and that was one of the things that attracted me to this job to begin with, or this industry, is that even before technology, insurance agents were always like virtual, and financial advisors, they just needed a phone and, their computer. It was always a kind of a remote position. There are people that have offices that clients can go to. Mm-hmm. I've considered that. I've thought about having a storefront office, or, in the future, or even maybe in an office building where employees can at least go to, and we can still do everything remote, but it'd be more for employees. And I might consider that. I might do that. The problem is in Chicago, rent is really expensive for offices. So
maybe that'll change.
Right.
It's tough to say, but COVID's changing a lot of things, and office space is definitely one of them.
Yeah, a lot of places downtown are converting from office buildings to apartment buildings and condos because they have all this empty room now, and they might as well change that expensive real estate from offices to, residential places.
Yeah, it's interesting because I look at my business, the call answering service with Calls on Call, and I'm paying for an empty office essentially, and I don't see us coming back.
Yeah.
It's been working despite me thinking that it would never work remotely. Mm-hmm. The crew that I have is solid. So I'm like, we don't need this space. And I'm certain that if I think that way, that there are businesses on a much larger scale that are thinking the same thing.
Yeah. In my building where I live, I'm always talking to people in the elevator, and they're like, oh yeah, I'm not going back to the office anymore. We're permanently working from home now. Mm-hmm. A lot of companies are doing that, because think about it, they don't have to pay rent anymore. Even if they were allowed to go back to the office, mm-hmm. they don't want to pay their rent. They don't have to pay internet there. They don't have to pay for insurance that protects the employees while they're there.
Right.
They get to save all this money by having people work from home. So I guess it does make, the only downside is that I could think about working from home is just kind of like the vibe of working with other people. That's the only downside. You kind of lose that.
Totally. That's a big one. Yeah, it's definitely a big one.
Yeah.
I guess that was the main concern that I had, was just, there was the camaraderie, the culture of the business. Mm-hmm. I didn't know that we could survive that remotely. Mm-hmm. But with instant messaging and, generally speaking, a somewhat younger workforce, mm-hmm. younger than me, for the most part, they thrive in that world. I would have a hard time with it because I just need to see people, I guess, and not on a 2-dimensional Zoom level. I mean, like,
yeah,
3-dimensional, shake hands, high five, whatever level. I just need that energy from people.
Yeah, you're right. And I think more things get done when you're actually in front of people talking to them. More things get done, totally. Especially from a sales and marketing perspective. Mm-hmm. You're more likely to close more deals. You're more likely to get referrals when you're touching people and shaking their hands, as opposed to doing everything virtual. Not that it's impossible, of course, mm-hmm. to do everything virtually, but just, I think, one step a little bit better to do things like face-to-face with people.
Yeah, I have this theory, and I don't have any math to back it up, but I'm like, okay, you don't pay rent. That's 20% of your revenue or whatever. That means essentially that your workforce can either be 20% lazier than they are, mm-hmm. and it's break even, or they can be 10% lazier and then you come out ahead 10%. Rough back of the napkin math kind of thing. Because I'm under the impression, I don't know this for sure, I don't have any data to back this up. No, nothing empirical anyways. I don't even know how you'd measure it as far as quality or quantity or volume of work that is done for a given hour of working from home versus working in an office. I guess there's water coolers and coffee makers in offices anyway, so they're not exactly working 100% anyways. I don't know what percentage that they're working at home. Maybe it's a higher percentage for some people. Maybe it's lower, but I feel like I would guess that it's a little bit less than at work, because you don't have someone breathing over your neck or saying, hey, Rodney, get back to work, you slacker. Kind of thing.
Yeah, that plus, I imagine if you have to commute to work, you have to drive like 30 minutes.
Oh, right.
You have to get up in the morning, and the second you wake up, you're thinking about not being late to work, right? That's probably your first thought. Totally. So you're getting ready, you take a shower, you get ready, you get in your car, you're driving on the highway, you get to work. By the time you get to work, you've committed so much of your life already, or they're done that day for work, and you're probably going to produce much higher results because you're not going to do anything else. You're not going to drive to work and then not work. you've already committed. You've already put in the commitment.
Yeah,
So yeah,
you got in the
definitely.
zone.
Yeah. Yeah.
Interesting. I never thought about that. How you're spending the time before you get to work, preparing yourself to actually be at work.
Mhm.
That probably explains why some people just get to work and then they start searching for what they're going to eat for lunch.
Yeah, because their primary thought waking up was just work. That's just not
Yeah.
hearing the boss say you why are you late. Just avoiding that for the morning.
Interesting. Yeah. Different world. Different world.
Yeah.
So why did you, just out of curiosity, what made you decide to go off on your own versus just becoming an employee of someone else where you could be making commission and making
Yeah.
sales essentially without the risk or presumably less risk?
Yeah, definitely. It would be more risk. There's a couple of downsides. So as mentioned already with the financial services world and those two avenues, working
Mhm.
fee only or commission only, if I'm an employee on one of those sides, I have to stay on that side, for example. So for example, if I'm a fee only advisor, number one, I can only be fee only. And then number two, uh, let's say, for example, I'm representing, ABC Mutual Fund. That's who I work
Mhm.
for. I can only represent ABC Mutual Fund. I have to have their business cards. I have to have their email address. I can't do anything else but ABC Mutual Fund. I'm a captive agent or a captive advisor to them.
Mhm.
That means if a client comes to me and says, hey, I want to get into real estate investing, I either have to turn them down or convince them otherwise. Real estate investing is too risky, do
Oh,
mutual funds
sure.
instead. And
All right.
that's one problem with the industry is the captive part of it is that it's too salesy in the sense that you kind of have to pull people away from what they're doing and push them more to the product that you can only sell. And now let's say I was, independent only, or I was on the commission side, but I was working for one company as a, independent whole life insurance agent, for example. Same
Mhm.
kind of idea. I could only sell for that one company. I can't sell for different companies. So I kind of wanted to put the agency in a position where it can pivot into different areas and do different services if needed. So our primary niche is, the bank on yourself strategy and using whole life insurance for small business owners and real estate investors. But if needed to, if I, for example, wanted to partner up with a mortgage lender and then get fees from that, I could do that. If I wanted to, partner with a real estate brokerage company and then kind of partner with business there, we could do that too. We can kind of pivot and move around. That's one of the main reasons why I want to be independent and self-employed. And then also, of course, with uncapped earnings, if I'm an employee somewhere, a W-2 employee, they're gonna, I think, structure my pay so that way it's kind of a little bit more than starting a business pay, but
Mm.
it's going to have caps. Even if they don't say it has caps, like for example, they'll say, we don't cap your earnings. You're still going to be capped in the sense of logistics and time and what you could do during your workday and how many people you could see. So you're going to be stuck in this point of like, you're making enough money to support your family, pay all your bills, have a little bit extra for vacations and for future savings, but you're not going to have enough to the point where you can kind of retire at the age of 50 if you wanted to. You'd have to keep working. So I
Sure.
wanted that uncapped earning potential.
Interesting. So you thought this through. I like
Yeah.
it.
Thank
I like it.
you.
So tell me from a legal standpoint, I'm just curious, are you considered a financial planner, life insurance salesperson, fiduciary? Like what do they pigeonhole you as from a legality standpoint, I guess?
Yeah, so legally, I'm not a fiduciary. I'm not
Okay.
part of a broker dealer, and I'm a financial. So technically, I'm a financial planner and an insurance agent, kind of both of those combined. And then
Hmm.
also sometimes I'll throw in like financial consultant, just to kind
Okay.
of consult on different financial matters. So it's kind of those three. I'm
Gotcha.
not a lawyer or an accountant or a fiduciary.
All right. So you tell me about the tests that you had to take in order to be able to sell these products.
Mhm. So typically, it's usually life and health only. I have life, health, property, and casualty insurance licenses
Okay.
and then there was 4 exams for those. And then after that, when I became a Medicare consultant, I had to do an exam through that to become Medicare certified. And then when I got into the Bank on Yourself organization, they have an 8-week like training program with the final exam. So I had to go through that. And then I also have like a long-term care certificate, professional certificate to help people manage or plan for long-term care. So it's kind of like, 7 exams so far that I've taken
All
to
right.
help position this. And then I'm working on I'm going to start taking courses for the certified financial planner, the CFP courses. That's like the next level to my business is the CFP part.
Okay. And that's where you get into the mutual fund stuff or
That's when I pretty much I'm still going to be doing what I'm doing now, but I guess the only benefit is just being able to put CFP on my resume and LinkedIn and business
Oh,
cards. Yeah,
gotcha.
it's just kind of like I'm taking everything I know and then just on steroids kind of, and just
Gotcha. Okay.
more thoroughly, more advanced in financial analysis and financial planning.
All right. Were these tests tough? Like, do people just walking off the street and take them, or do you got to study night and day for 50 years to get them? Or
They're not tough. You don't have anybody could take them, even if you just kind of graduate high school, but it does take practice. I'd say the average one that I took takes about 20 hours of prep or 30 hours of prep. Maybe I've seen
okay,
people fail. I've seen a lot of people fail them, and
okay,
I've seen a lot of people pass them, who don't even have college degrees. So it's passable. It's very
hmm
manageable, but you just have to put in the time. Like some of my colleagues and friends will call me and say, "Hey, I want to take the life and health insurance license. What are some things to know?" And I tell them, devote at least 30 full hours to it, have a set schedule, and then don't try to do the entire pre-training in one day or a few hours. Split it up like 3 or 4 hours every day for a whole week, and then make it more of a rhythm, because it is, if you don't do that, you probably will fail.
Gotcha. Interesting. And then I know we don't have a ton of time left, but I do want to talk about the bank on yourself organization.
Mhm.
Is that a franchise, or how did you get involved with that?
Yeah, so it's pretty much, it's a concept and it's a trademark, and it's also part of something called like an insurance marketing organization, where it's like an upline. So for example, let's say that Lafayette Insurance Company is one of our carriers, right?
hmm
When I go through Lafayette Insurance Company, I go through an upline marketing channel, and then that marketing channel gets a piece of my commission. In exchange, they provide me with support and training and other things like that. So the Bank on Yourself organization is kind of like an IMO, or insurance market organization, and it's also a trademark and a concept. So pretty much they have the book, they have the training material, I have a mentor, they train me, and then the business I write goes through them. So
Gotcha.
mhm,
Okay, so you didn't have to call up these insurance companies individually and say, "Hey, trust me, I'm super awesome at what I do. Let me sell your product." You went
exactly,
through
yeah.
Bank on Yourself organization, who essentially vetted you.
Yeah. Mhm,
Gotcha. Okay,
yeah.
I wondered how you did that.
Yeah. Yep.
Just because you call up an insurance, or I would call up an insurance company, and they'd say, "Who are you?"
Sometimes the insurance companies will actually call you and ask you to sell their products. So yeah, sometimes it depends. Some insurance companies don't accept people just off the street. They need it to come from an upline. So that way
hmm
they have the trust, they did the vetting.
hmm
And then sometimes the insurance companies like don't really care. This is more not on the financial planning side. This is more of like, you want to sell, for example, dental products, dental
hmm
insurance products, or like vision insurance. You can call those companies and just sell through them, because they're looking for business, right? And every
Yeah.
broker is essentially a money maker for them.
Gotcha.
But other companies that are dealing with more of people's lives and cash flow and cash savings accounts, they want people to come through like a vetted network.
Gotcha. That makes sense. Awesome. So, Sarry, I got a couple more questions for you before we wrap up here.
Yeah.
Can you just give it the Cliff's Notes version of term versus whole life and anything in between there?
Yeah, so pretty much term is a set period of time. It's either 10 years, 20 years, 30 years. It's life insurance only. There's no cash value in it. So for example, somebody would get a life insurance policy for 20 years, pay, $100 a month. If they pass away, the insurance company will pay out $1 million. And if they don't, if they have 20 years goes by, the insurance company is now off the hook. You don't have to pay any more money, but you don't have there's no equity, there's no cash value in it. And you could renew it for another 20 years if you wanted to. Whole life, it's for your whole life. Once you start the policy, it's a permanent form of life insurance. There's no underwriting again. There's no end date. It only ends when you pass away. And then the other difference is it has equity in it, or cash value. It's like buying a house. You buy the house, you have the market value, and you have equity. Whereas term is more like renting, and it's a set period of time, and it's only life insurance. Those are kind of the
hmm
differences between term and whole life.
Sure. And then pros, cons. Can you talk about
Yeah.
that?
Yeah. So term is, it's since it's only life insurance, and as mentioned, 99% of cases don't even make it to a death benefit. It's
hmm
fairly cheap. Somebody who's 40 years old can, pay $100 a month for $1 million in life insurance. Whole life insurance is going to cost more because there's more risk on the insurance company side. It's for your whole life. They have to keep you on their books for your whole life. They already made that commitment. So that means if you get into the policy, you're healthy, and then 10 years later you're diagnosed with cancer, the insurance company can't reject you now. They have to
Mm.
keep you. They can't re-rate you now. You've already locked in the rates at a lower rate. So they have to keep you, and they have to add in that risk when evaluating you. And then of course there's a cash value component too. The fact that you have the ability to borrow against your money and use it for retirement or use it for whatever you want, the insurance company also has to collateralize the loan parts of that policy using it, which costs money, of course. Typically with whole life insurance, the fees are highest in the first 2 years. And then after that, as mentioned, there's a break-even point, and then you end up getting your money back. So a lot of clients would actually say they would prefer whole life because you would recoup the cost of insurance. Eventually, you recoup the cost of insurance. Whereas with term, you would never recoup it because either you would have the policy run out or you would pass away and you get the life insurance amount.
Right.
But now sometimes we could do both. A lot of times we do both. We do term and whole life. We do whole life for the cash savings part and the self-banking part. And then we do term only if something happens to them in a 30-year time period, all their debts are paid off.
Gotcha. Interesting. Huh. Clever. Cool. Sarry, how can people find you?
Yeah, so they can go to our company website. It's finassetprotection.com, FIN assetprotection.com. There's a link. You can schedule a free appointment for a conversation. There's also a link to my LinkedIn if you want to connect there and get to know me first. Yeah.
Awesome. Very cool. Do you have any questions for me, I guess, before we wrap this up, or anything else that I should have asked you?
No, I really appreciate the questions you asked, and I really appreciate being on your show, James.
Yeah, this has been super cool. This has been insightful, I guess. I want to ask one more question here. Just for the listeners, we got a pretty wide-ranging audience, entrepreneurs that are just starting out and entrepreneurs that have been entrepreneurs for, well, decades, really. So is there a, I don't know how to ask this without sounding rude to the person. Let's just say, is there a personal value or asset value, not necessarily the person, I didn't mean it to sound like that, but an asset value where it makes sense to look at something like this, a product like this, versus term, like if they're making more than X dollar amount in a year with their business?
Oh, gotcha.
You know what I mean? Like if someone's like, hey, I'm bringing in $50 a year for my business, I think whole life is the right policy. Probably going to be like, maybe not yet.
Yeah, that's a good question. I get it. Yeah. So pretty much like the financial brackets people are in, and
yeah, there's probably a point, I guess, I imagine, and correct me if I'm wrong, but there's a point where there's a rough grayish area where once you hit that number, then it starts making sense to look at something like this.
Good. Yeah. Awesome question. Yeah. So definitely. So pretty much, as I mentioned, we could do policies, that are like $300 to $500 a month. And then we could do policies all the way up to $1 million. And it comes down to, or a year even, or a single premium. That's possible. There's no caps to how much whole life insurance you can get from an underwriting perspective, or from a tax perspective. There's no limits on it. Now, let's say, for example, somebody is, 30 years old. They're listening to this. They're like, hey, should I do this? Is this a good idea? My question to you would be do you have like $300 or $500 a month that you can save extra that's just sitting in a boring business, boring, checking account? Instead, could you have that sit in a whole life policy, earning you more interest while still giving you liquidity to use for other investments that you want? Now, if you're completely, you're a W-2 employee and every check you get completely goes to bills, for now, I wouldn't recommend this because it does take commitment, right? To commit to $300 to $500 a month to this every single month. So if you're in that situation of like paycheck to paycheck, I wouldn't do that right now. But I would definitely, if you have, $300, $500 extra after paying all your expenses, all your bills, why not have it sitting somewhere that'll earn you compound interest? Also, another really thing I like about this is that it almost forces you to save your money, because if you commit to, $500 a month for 30 years, you have this bill almost every month that you're paying into. But as you're paying into it, it's building up cash somewhere. And then when you want to access that cash, you can at any time. You could borrow up to 90% of the cash value. You borrow from that, you use that for whatever you want, you pay it back into the policy. So now what's happening is you're creating obstacles around your money that you're in control of course, but you have these obstacles around your money. And this allows you to save more money over time. Because think about how many people do you know take money from their checking account, put it in their savings, 1 month later, go to their savings, take it from their savings, put it back in their checking, and then they wonder why they can't save money. And I was the same way before I started all of this. I always wondered, why can't I save my money? And it's because of the liquidity part of your money. It's too liquid. If you can access your money over your phone, chances are you're not going to be able to save it.
Oh, I love that. You make it too easy.
Yeah, exactly. So add some boundaries, some barriers around you and your money. I'm not talking about locking up your money for 30 years. I'm talking about locking it up. And when you want to access it, you have to wait 3 to 5 business days. And it makes you really think about using your money. You're more likely to save it for the future.
I love that. That is impressive. That alone is worth it for listening. The people listening to this right there. Because you're totally right, man. People have essentially too much easy access to money. I suppose you could argue the whole credit card thing for a lot of people.
Yeah, definitely.
It's too easy to spend.
Yep.
Or to access their money. And so therefore, even though it was saved maybe a month or two, it's gone this month.
Exactly.
So that's awesome. Incredible advice.
Thank you.
Well, Sarry, thank you for being on the show. This is super cool.
Thank you, James. Thank you for having me on.
This has been Authentic Business Adventures, the business program that brings you the struggle stories and triumphant successes of business owners across the land, underwritten by the Bank of Sun Prairie. If you're listening to this on the web, please give us a thumbs up, subscribe, share, comment. Just spread it to the world. That's what we need you for. My name is James Kateman, and Authentic Business Adventures is brought to you by Calls on Call, offering call answering services for businesses across the country on the web at callsoncall.com, as well as Draw In Customers Business Coaching, offering business coaching services for entrepreneurs looking for growth on the web at drawincustomers.com. And of course, the Bold Business Book, a book for the entrepreneur in all of us, available wherever fine books are sold. We'd like to thank you, our wonderful listeners, as well as our guest, Sarry Ibrahim, a financial professional, a member of the Bank on Yourself organization, and owner of Financial Asset Protection. Sarry, can you tell us your website one more time?
Yeah, it's finassetprotection.com. F-I-N, asset, protection.com.
Asset is plural or just singular?
Oh, singular.
Singular. Awesome. Past episodes can be found morning, noon, and night at the podcast link found at drawincustomers.com. Thank you for listening. We will see you next week. I want you to stay awesome. And if you do nothing else, you know what to do. Enjoy your business.